There's a catastrophic mistake that many traders make when trading options that can just decimate your return potential and cost you so much money, but it's so easily avoidable, as you're going to learn in this video. Are you making this mistake? You're about to find out. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And professional options traders face lots of challenges, but the good news is that some of the most devastating challenges can be very easily solved with just a little bit of knowledge, and that's what we're going to be sharing with you in today's video. And once you learn what we'll be teaching you today, you can avoid a terrible mistake that most options traders make, which will have the potential to dramatically improve your potential results as a trader if you simply apply it. You're going to be amazed at how easy this fix is and how devastating it is if you don't follow the simple rule we're going to teach you today. Now, before we get into the details of this very simple fix to your options trading practice, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so in order to explain how this mistake can be avoided, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so with that said, what I'd like to share with you today is the issue of executing what professional options traders refer to as complex orders, which sounds complicated, but it's actually really simple. You see, most traders, when they think about options, they think about buying a single call or a single put. But there's another kind of order, a complex order, which is any options trade that involves the simultaneous execution of 2 or more options. And any orders that come into the market that involve 2 or more options executed simultaneously are electronically posted in what is known as the complex order book. And that way the rest of the market can become aware of these orders and decide whether or not they want to fill them. So let's take a look at an example of a complex order. Suppose that this week you had pulled up an options chain for the NASDAQ 100 index, known as the NDX, that expires in about 2 months on January 20th of next year. And you went ahead and simultaneously bought 10 of the 11,775 calls, sold 10 of the 11,625 calls, and at the same time sold 10 of the 11,625 puts and bought 10 of the 11,475 puts. Well, if you had done that, you would have put in an order for what options traders refer to as an iron butterfly, which, as you can see, is a four-legged position comprised of short puts and calls at the same strike price at 11,625, and then long options 150 points away from the short options, with the long calls being higher up at 11,775 and the long puts being lower down at 11,475. Now, what happens from a cash flow standpoint when you enter into an iron butterfly, of course, depends on the pricing that you get for the options. And so let's take a look at each option that comprises our iron butterfly. And as you can see, each option has a bid price, an ask price, and a mid price, which is halfway between the bid and the ask. And so when you enter what is known as a limit order for a complex option spread, or any trade for that matter, you are in charge of the price at which the trade is executed. You set a price, and then the market either meets your price or it doesn't. And it's customary for the market to generally have a willingness to split the difference and execute the options at halfway between the bid and the ask, which in other words is what we're calling on this slide the mid prices, which are highlighted in yellow on this slide. And so if you had indeed executed the trade as a limit complex order for the mid price for each of the options, let's take a look at what that would look like from a cash flow standpoint. And so starting with the options you sold, you can see that the mid price of the 11,625 call was 534.75, and each option pays off $100 per point beyond the strike price of the option. So you multiply that by 100, and you sold 10 of them. And so multiplying it all together, you get total cash inflow of $535,750. And using that same logic, you receive $458,200 for selling the 10 11,625 puts, but then you turn around and pay out $455,450 for the 10 11,775 calls, and you also pay out $396,650 to buy the 11,475 puts. So when you net it all down, it comes out to a positive cash flow of $140,850, as you can see from the calculations. And by the way, and this is really important, your broker, because of margining rules that they are governed by, will require you to have at least $9,150 in your account in order to execute this complex order, which is also the most you can possibly lose on the trade. And so the cash flow is the maximum that you can make on the trade if it goes perfectly. And so if you think about it, the reward to risk ratio is 15.39 to 1, because your maximum gain divided by your maximum loss is 15.39, as you can see. And so had you put your complex order into the market as a limit order, requiring that the market hit the mid price on all of the options, you'll normally find that with a little bit of patience, you can normally get that trade filled. And so that would have been, let's say, your fill on this day for a limited order. However, there's a different kind of order, which is called a market order. And that's where, instead of you setting the price, the market essentially sets it for you, which is, you're about to see, is a very bad idea. You see, when you execute a market order, which is one of the choices your broker will always give you, they don't ask you a price for each of the options. Rather, they assume that you are okay with buying every option at the ask price and selling every option at the bid price, which of course is the worst price in both cases, because the ask price is essentially the most you could pay at that moment for that option, and the bid price is the least you'd receive for that option if you were to sell it at that moment. And so you get the worst of both worlds on the options that you're both buying and selling. So now let's take a look at how it would play out if you were to instead make this a market order. And as you can see, for the two options we're selling, the 11,625 call and the 11,625 put, we are receiving the worst of the three prices. And for the two options we're buying, the 11,775 call and the 11,475 put, we are paying the most that we could possibly pay for those two options. Now, let's see what this means from a cash flow standpoint. And as you can see, instead of collecting over $140,000 for selling this iron butterfly, we're instead collecting just over $130,000, like a $10,000 difference for the exact same trade. And your broker in this case, by the way, very importantly, is going to require more than double the capital you were required to have in your account to enter into this trade because of the lower price. They're going to require you to put up over $19,000, in fact, which will result in your reward to risk ratio dropping from over 15 times the risk to under 7 times the risk, simply because you put in the wrong kind of order. So in summary, the limit order is superior in every respect. You get paid more for the Iron Butterfly, you're required less capital for the exact same trade, and your risk reward is more than twice as attractive in this case, all because you decided your entry price, not the market. So what I'd like you to take away from today's video is the fact that you should never, ever use market orders when executing complex options orders. The bid-ask spreads are too wide compared to most individual equity names, which means that for each option in the multi-legged spread, you are either being paid the lowest possible price that you can possibly receive for options you're selling, and simultaneously you are paying the most you could possibly pay for the options you're buying. Selling low and buying high is not exactly a recipe for a successful transaction, and professional traders will usually make this mistake once because it totally blows up the economics of the trade, and that's a lesson you tend to remember, believe me. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. It's good to avoid mistakes, but you also need to know what to do, not just what not to do. To learn an option strategy that gets in and out of the market in just one day for short-term hit and run trades, click the video appearing now on your screen.